APR and interest rates are two terms that often confuse people, yet they play a major role in how much you actually pay when you borrow money. Many lenders advertise low interest rates, but what really matters is the APR. Understanding the difference can save you hundreds or even thousands of dollars over time. Let's start with the interest rate. The interest rate is the cost of borrowing the principal amount of a loan. It is usually expressed as a percentage and represents what the lender charges you each year for using their money. For example, if you borrow $10,000 at an interest rate of 5%, that 5% is applied to the loan balance to calculate interest charges. However, the interest rate does not include any additional costs associated with the loan. It only reflects the base cost of borrowing the money itself. This is where many people make mistakes when comparing loans. APR stands for annual percentage rate. Unlike the interest rate, APR gives you a more complete picture of the true cost of a loan. It includes not only the interest rate, but also certain fees and charges required to obtain the loan. These may include origination fees, broker fees, mortgage insurance, or other lender costs, depending on the type of loan. Because APR includes these extra costs, it is usually higher than the interest rate. This makes APR a more accurate tool when comparing loan offers from different lenders. To understand this better, imagine two loan offers. The first loan has a 4% interest rate, but includes high upfront fees. The second loan has a 4.5% interest rate with very low fees. At first glance, the first loan looks cheaper, but once you calculate the APR, the second loan may actually cost less over time. APR is especially important when comparing loans with different fee structures. If two loans have the same term length, the one with the lower APR is generally the better deal. It's also important to understand how APR works differently depending on the type of loan. For credit cards, APR represents the yearly cost of carrying a balance. If you do not pay your balance in full each month, interest begins to accrue based on the card's APR. Credit card APRs are usually much higher than those of mortgages or auto loans. For mortgages, APR includes not only the interest rate, but also closing costs and certain fees spread out over the life of the loan. This is why mortgage APRs are often noticeably higher than the advertised interest rate. Another key factor is how long you plan to keep the loan. APR assumes that you will keep the loan for its full term. If you pay off the loan early or refinance, the APR may not reflect your actual cost. This is especially important for mortgages, where many borrowers refinance or sell their homes before the loan term ends. Interest rates, on the other hand, are more useful when estimating your monthly payment. A lower interest rate usually means a lower monthly payment, even if the APR is higher due to fees. This is why some borrowers prioritize interest rates for short-term loans and APR for long-term cost comparisons. So which one should you focus on? The answer depends on your goal. If you are comparing loan offers, APR is usually the better metric because it reflects the total cost. If you are focused on monthly affordability, the interest rate plays a larger role. The smartest approach is to look at both. Compare APRs to understand the true cost and review interest rates to see how they affect your monthly payment. Many lenders highlight interest rates in large print because they look attractive. A PR is often displayed in smaller text, but it carries more important information. Always read loan disclosures carefully and ask lenders to explain any fees included in the APR. Understanding the difference between APR and interest rates puts you in control. It helps you avoid hidden costs, make smarter comparisons, and choose loans that align with your financial goals. Before signing any loan agreement, take a moment to compare APRs, review interest rates, and think long-term. A small difference today can make a big difference in your financial future.